Today we are going to see Accounting for Managers 1, and I am A. Lakshmipriya, Assistant Professor, Department of Business Management. So in this video we are going to see the meaning of financial accounting, objectives of the accounting, branches, types of accounts, accounting principles, and the uses. So first of all, what is that accounting? Accounting is a systematic process of identifying, recording, measuring, classifying, verifying, and communicating the financial information. It reveals profit or loss for a given period and the value and the nature of a company's assets and liabilities and the owner's equity. So this accounting is the systematic approach. It has its own rules and regulations. So some principles which are to be followed in order to classify all the money related transactions. So the first and foremost thing is that the transactions which takes into account the money based, money related, so only those are recorded, those are verified, those are measured for the business accounts. So it reveals the profit or the loss for a given period. So take for instance for the last month, for the quarterly basis, or for the half yearly, or for yearly basis, we will be knowing the financial position of the company. So that is the financial accounting. So now we will be seeing the components of the financial accounting. So the three main components are there in the financial accounting. Those are the profit and loss account, cash flow, and the balance sheet. And this financial accounting is based upon some process. So it starts from the source document. From the source document, the entries are made in the journal book. From the journal book, the entries are posted into the ledger book. From the ledger, the closing balances are taken into the trial balance. From the trial balance, the financial statements are prepared. So this is the accounting cycle. It starts from the source documents, and from there it goes to the journal book. From the journal book, the entries are posted into the ledger, then to the trial balance. From the trial balance, it is given to the financial statements. So for the financial statements, it is verified with the source documents. So these are the stages for a accounting cycle. The main objectives of accounting is that systematic recording of the business transaction. We have to maintain the bookkeeping where the journal, ledger, and the trial balance are prepared in order to ascertain the results for a manufacturing concern or for the trading concern. The profit and loss account is prepared, and from there we can know about the financial performance of the company. And also the financial position is known from the balance sheet. So on a particular date, whether the liabilities and the assets of the company are said to be balanced or it is said to be equal. So it reveals about the position, the financial position of the company, and it is said to be one of the forums which is used in order to communicate the information to the various users. The financial reports are prepared. From that report, those people who are connected with the company can know about the results. So next comes the branches of accounting. So basically we have three branches: financial accounting, cost accounting, and the management accounting. In the financial accounting, we'll be recording all the money related transactions, whatever happened in the business. So after happening, those transactions are recorded in the books of accounts. We have some concepts and the conventions in order to prepare the books of accounts. So in the financial accounting, it is said to be the first and foremost step. We'll be preparing journals, subsidiary books, ledger accounts, trial balance, and from the trial balance, the final accounts are prepared, which has the profit and loss account and the balance sheet. So next comes the cost accounting. In the cost accounting, we'll be having the cost sheet, the material cost, labor cost, other expenses cost, and also the reports are prepared for the standard cost report, variance report, break-even point, marginal cost report, and the price determination. So where we'll be getting the data is that we'll be getting the data only from the financial accounting. So for tenders, in order to apply to the tenders, cost accounting is said to be the base. The cost sheet is prepared for a product or the service. which is to be rendered or which is to be produced. So from there we'll be knowing the total expenses in order to produce that particular product or to render that particular service. And next comes the management accounting. So it relates with the taking some vital decisions. So here we'll be having the financial statement analysis through which the company's financial performance is analyzed and it is interpreted. So for that we'll be using the tools and techniques through which the financial performance of the company is analyzed. The first one is the financial statement analysis, which has the comparative statement analysis, common size statement analysis. Then we'll be having the trend analysis and in-depth analysis. We'll be going with the ratio analysis. Each and every item of the financial statements are analyzed, and there we'll be knowing the exact financial performance of the company. So here we'll be having the ratio analysis, and the next one comes the fund flow statement analysis, cash flow statement analysis. So through which we'll be knowing how the funds came into the business and how the funds are utilized, and also the proper cash management, how they are managing the cash. So this is known very well known with the use of the fund flow statement and the cash flow statement analysis. From that we will be preparing some reports, the budgetary reports, and also the interpretation. So all the interpretations are made nowadays with the help of the technology. The computers will be preparing the reports through the MIS. Next comes the differences between the financial cost and the management accounting. So basic objective of the financial accounting is in order to record the transactions and in order to determine the financial position of the company. Whereas in the cost accounting, the ascertainment, allocation, accumulation and accounting of the expenses, how much to be incurred in order to produce a product or the service. On contrary, in management, this accounting is mainly used in order to assess the management where the important decisions are to be made and in order to formulate some important policies. Next comes the nature. So financial accounting is said to be with the historical data, that is after happening that expenses it is recorded. In the cost accounting, it is concerned with the both past as well as the present. So in order to grab the tenders, the government tenders, it will also take into account the present values or the present expenses for calculating the total expenses for a project or to produce a particular product. Whereas in the management accounting, it deals with the projection of the data, which is said to be futuristic. So in future, how much profit will be getting, and based upon that projects will be selected. So in future, how much we are going to target, what is our target for all the departments, either it may be a production department, marketing, dash, for everything we'll be preparing the foreseen. It is said to be foreseen and we'll be preparing in advance. So what is the principle we have followed here in our financial accounting is that GAAP is followed. It is governed by the GAAP. And for the cost accounting, we have some principles for recording the cost, and there is no set of principles which are followed in the management accounting. So what data used in financial accounting is that the qualitative aspects are not recorded, and in cost accounting also only the quantitative aspect is recorded. In management accounting, it records both the qualitative and the quantitative concepts. So next comes the types of the accounts. So the types of accounts also we can take it as the golden rules of the accounting system. So where the accounts are classified into three: real account, personal account and the nominal account. So the golden rule for the real account is that debit what comes in, credit what goes out. The golden rule of the personal account is that debit the receiver, credit the giver. And in the nominal account, the golden rule is said to be debit all expenses and losses, credit all incomes and the gains. So in a business concern, if you take, we'll be having some tangible and the intangible assets. So those are said to be the real account. So whatever is coming inside the business, that is debited. For instance, if you are purchasing any machinery, so it comes inside the business, so we'll be debiting that particular machinery account. So in return, if you are purchasing machinery, means in return we'll be giving the cash. So the cash is going out of the business, so credit the cash account. Okay, so that is the main rule of the real account. So debit what comes in, credit what goes out. And in the personal account, the rules are said to be debit the receiver and the credit the giver. So any business, it is connected with the people. Only the people are connected with the business. They'll be either rendering some service, or they'll be receiving some service, or they'll be purchasing some products, or they'll be selling some raw materials to the business. So whenever some person is receiving, so we have to debit them. Whenever someone is giving to the business, then we have to credit them. So that is the personal accounts rule. And for the nominal account, so we have some expenses in order to run the business. We'll be incurring some expenses, and also it is quite nature that we'll be incurring some losses also. So take for instance the rent we are paying, and the electricity charges, any commission which is paid, salaries we are paying to the employees, wages we are paying to the laborers. Those are all the expenses. Without the expenses, we cannot lead a business. So all the expenses and the losses to be debited. So what to be credited? So all the incomes and the gains are to be credited. So the profit, or it may be any income you have deposited and you are receiving some interest. So those are all the incomes which you can credit. So some examples for the types of the account is that personal account, Rom's account, bank account, Dubey, Mohan. So these are all the persons who maybe the debtor or the creditor. Bank is said to be and person to be considered to be a person. And in the impersonal account, for the real account, so we have the examples as the plant, machinery, cash in hand, and the goods, the stock. Okay, so these are all said to be tangible, which is said to be visible. And in the nominal, which is said to be fictitious, salary that we are paying, discount, it may be you will be receiving the discount, or you will be allowing the discount to your customers, wages, and the postal charges. Accounting principles. So the accounting principles are framed on three bases. One is the assumption, on the basis of the concepts, and on the basis of the conventions. So under the assumptions comes the four major factors, that is the business entity, money measurement, accounting period, and the going concern. For any business, it is said to be running business. Okay, so it is assumed that this will remain for year after years. It will be continuing its business year after year. So in that concept, in the basis of that assumption, the money is measured and it is given a separate entity, and then accounting period is fixed, and it is said to be going concern. The persons may come and go, but this concern is said to be everlasting. It will be everlasted. So that is the main assumption. For the concepts, so it is said to be dual aspect. For any action, you will be having a equal or the opposite reaction. So here, if you have a debit, then automatically you will be having corresponding credit entry. That is the dual aspect. Revenue realization. So why we are doing a business? Only to get the revenue, only for getting some income. So that revenue realization, based upon that, to know whether we have realized the revenues or not. From that concept, we are preparing this accounts. So historical nature, only after happening that particular event or the transaction, it is recorded in the books of accounts. So without happening, no entry will be posted in the books of accounts. So we have to match the transaction, the exact transaction, whether it is incurred. For that we have some evidences. So if you are selling, then we will be providing some receipts. When we are purchasing, we'll be having some invoices. So the proper document to be supported should match with the entries, the cost concept. So we'll be incurring some expenses. That is that to be inevitable, that you cannot avoid. So only if you are spending some expenses, then you will be making some profits. So object evidence. So if I'm purchasing any machinery and if I'm purchasing any furniture, for that I need some evidence. So that is said to be the main concept of the accounting. And the convention. The convention is that it has to fully disclose all the expenses and the incomes. Materiality. So basically the books of accounts are said to be materialistic. We'll be having all the entries, whether it is an expense or it is an income, how much sales we have made, in the amount basis. It is shown in the amount basis. So some materialistic evidence will be provided with the principles of accounts, and there will be some consistency. So continuity will be there in the accounts. It is maintained day after day, weekly, monthly, and yearly. So conservatism. So that is also an important convention. So it is basically with the principles. So whatever the golden rules we are following, it has its own limits in the preparation of the accounts. So who are the users? Who are all the users of the accounting information is that, so owners, the business owners, the managers who are managing that particular business, employees of the company, those are all said to be the internal users. And when you come to the external users, the people who were invested in that particular company, the people who have lended their money to that particular company, the raw material suppliers, the customers who had purchased from that particular company, the tax authorities, government, auditors, and the general public. So with the financial accounting, what are the basic careers? The main important careers is that you can become a financial accountant, you can become an auditor, you can become a financial manager, and also the controller of the funds, some management accountant, and the financial analyst. So these are some of the basic financial accounting careers. Thank you for watching this video.